Micron just shed 6% of its market cap in a single trading session, roughly $8 to $9 billion in shareholder value, gone before the closing bell. That is not noise. A move that size on volume this heavy means institutions made a deliberate decision to reprice this asset. And they did it fast. So the only question worth asking right now is whether they are right, or whether the crowd just handed disciplined investors a discount window into one of the most critical AI infrastructure plays in the semiconductor space. Stay with me, because the answer is more specific than you think. Before you can assess whether a 6% move is justified, you need to understand what actually caused it. Not the Twitter summary, not the headline, the mechanism. In Micron's case, the sell-off in June 2026 traces back to a convergence of pressures that have been building for several weeks, and they broke through the surface simultaneously today. The first pressure point is DRAM spot pricing. Data from industry trackers shows DRAM contract prices have softened meaningfully in the second quarter of 2026, particularly in the PC and consumer electronics segment. That matters because even as Micron's HBM, high bandwidth memory, business for AI data centers has been a genuine bright spot, traditional DRAM still represents a substantial portion of total revenue. When spot prices compress, the market starts discounting forward margins before the earnings report even arrives. The second trigger is guidance anxiety. Micron's last earnings call included language about the cadence of HBM shipments ramping through calendar 2026. And any macro signal, whether that is a softer than expected data center capex print from a hyperscaler or a broader risk-off rotation, gets immediately translated into skepticism about whether that ramp holds. Investors are not just pricing what Micron earned last quarter. They are pricing the probability distribution of what it earns 6 to 12 months from now. The third element, and this one is underappreciated, is sector rotation. On days when the broader tech tape weakens, semiconductor stocks bear disproportionate selling pressure because they carry the highest beta to the AI growth narrative. Traders who want to reduce AI exposure quickly do it through liquid names, like MU. The actionable insight here is simple. Separate the signal from the mechanism. Not every 6% drop is a fundamental re-rating. Sometimes it is a liquidity-driven amplification of an existing concern. Knowing which one you are dealing with is the entire game. Now here is where we have to be rigorous because this is not financial advice. And the goal is to teach you how to think about this, not what to do. The question of whether a sell-off is justified requires you to look at three things in parallel: the fundamental trajectory, the valuation before the drop, and the historical behavior of the stock in similar setups. On fundamentals, Micron's HBM story is structurally intact. Every major AI accelerator, NVIDIA's Blackwell architecture and its successors, AMD's MI series, requires HBM at a density that only a handful of companies on Earth can supply. Micron, alongside SK Hynix and Samsung, sits in that exclusive group. The global HBM market is projected by multiple semiconductor research firms to grow at a compound rate that makes the current cycle look like the early innings, not the peak. Micron has been qualifying its HBM3E product with major customers, and that pipeline does not evaporate because spot DRAM prices dipped for one quarter. On valuation, before today's drop, MU was trading at a forward price-to-earnings multiple that was already pricing in meaningful earnings growth, somewhere in the range of 20 to 25 times forward earnings depending on the estimate set you use. After a 6% compression, that multiple becomes incrementally more attractive on a relative basis, assuming the forward earnings estimates hold. That is the critical assumption. If analysts begin cutting fiscal 2027 estimates materially in the next few weeks, the stock may not be as cheap as it looks on today's tape. The historical pattern is worth noting here. Micron has experienced 12-month forward returns that have been significantly above market average when purchased during sentiment-driven drawdowns of 5 to 10%, provided those drawdowns occurred during periods when the underlying memory cycle was still in expansion. The current cycle, driven by AI inference and training infrastructure, has different demand characteristics than the consumer-driven cycles of the past. That makes the historical comparison useful, but not determinative. The justified or not verdict, partially justified on cyclical DRAM concerns, likely overdone relative to the HBM structural thesis. But the market does not settle arguments on logic alone. It settles them on earnings prints. Days like today are where investing discipline is actually built or broken. If you are newer to following individual stocks, a 6% single-session drop in a large-cap semiconductor name feels catastrophic. The cognitive response is either panic or the opposite mistake, which is reflexive buying without a framework. Let me give you the framework that experienced participants use to process moves like this, because it will serve you across every sector and every market cycle. First, distinguish between price risk and business risk. Price risk is the stock going down. Business risk is the underlying company losing its competitive position, its customers, or its ability to generate cash. On any given day, the market can create enormous price risk from very modest business risk. And it can also occasionally signal genuine business deterioration before the financial statements confirm it. Your job as an investor is to figure out which scenario you are in. For Micron today, the business risk appears limited relative to the price risk being expressed. Second, understand that volume is context. A 6% drop on average volume might be a technical break or a thin market overreaction. A 6% drop on heavy volume means real money made a deliberate decision. That deserves respect, even if you disagree with the conclusion. It means you are not the only one who knows something. It means well-resourced participants with more information flow than most retail investors saw enough reason to act. Third, position sizing is your actual risk management tool, not your ability to predict the bottom. You will never call the exact floor on a move like this. No one does consistently. What you can control is how much exposure you carry relative to your conviction and your time horizon. Fourth, and this is critical, semiconductor stocks are not buy-and-forget positions. They are cyclical businesses wrapped inside a secular growth story. The secular story, AI memory demand, is real. The cyclical volatility, DRAM pricing swings, inventory corrections, margin compression quarters, is also real. Anyone who tells you Micron is a one-dimensional AI winner without acknowledging the cycle is selling you a simplified narrative. The honest version is that MU is a high-reward, high-volatility asset that rewards patience and punishes leverage. If today's 6% move tested your conviction beyond what your research supports, that is information about your position size, not about the company. Build your view on data. Size it to what you can hold through noise, and revisit the thesis when the next earnings print arrives. So here is where we landed. Micron's 6% drop was real, institution-driven, and partially rooted in legitimate DRAM cycle concerns. But it appears to overstate the damage to the HBM structural thesis that makes this company relevant to the AI infrastructure decade. The price moved more than the business did today. Now the question that matters next. What does the next Micron earnings print actually confirm or deny about that HBM ramp? And what does it mean for the broader memory sector? That is the next video. Subscribe so you do not miss it.